Good morning, good afternoon, good evening to you all, and thank you for joining this webinar from Carbon Tracker. Delighted to have the opportunity to run through our recent note focusing on the alignment of the EU gas utilities and the with Paris. Why is this important? Well, because obviously their impact on their earnings and future earnings going forward will become ever more relevant. Today, I'm joined by Chris Moore, who is the Senior Analyst at Carbon Tracker for Corporate Research in the Power and Utilities space. And also I'm joined here by Catharina Hillenbrand van der Neem, who is Head of Corporate Research. The goal for us today is to run through and give you, the audience, and the investors an opportunity to understand how we think you should be assessing each of the companies we're going to discuss, their alignment with Paris, and how to drill down with the companies to get the real answers. So the format today will be, we'll have a brief introduction by Catharina on our exciting new work stream in corporate research, and then Chris will dig down and gallop through his presentation, and we hope to have a small amount of time at the end of this program to take some questions. So it's important that if you do want to ask a question, that you do so, but don't do it anonymously, because if you do it anonymously and we don't get round to answering that question, we won't be able to follow up after the event to help you with your queries. So without further ado, over to you, Catharina.
Good morning, everybody. I'm very pleased to welcome you all to our corporate research webinar on the European gas utilities. Thank you, Simon, for the introduction. As said before, I am the Head of Corporate Research at Carbon Tracker, and this is very important work for us because we really help investors, the market, and anybody interested getting their heads around what do the broad concepts of the energy transition planning, risk of the transition, and alignment with the Paris Agreement mean for each company involved. We have got a fantastic bunch of corporate analysts who have got really strong backgrounds in the city and in companies on Wall Street, and I've looked at these companies for a long time. They look at the oil and gas sector in North America and in Europe, and the power and utilities sector in Europe, Asia, and North America. So there's a very strong team here. You may even know some of them. And we will be rolling out our coverage of the largest companies, of those where we see there's a lot of work to be done. And we hope that we will have a lot of interesting interaction with yourselves on these companies, and we hope that this provides some stimulating ideas how even you yourselves might interact with managements. So with that, over to Chris.
Thanks, Catharina. My name is Chris Moore. Looking forward to presenting to you today. This presentation today will look at the Climate Action 100 plus European gas names. We'll look at Centrica, Engie and Naturgy as the three names in that space. We also published on the European coal names in the CA100 space last September. So that's names like CHEDS, PGE, RWE and Uniper. We will talk today about gas price volatility and the security of supply. We'll talk about the costs of keeping gas open. We'll talk about Scope 3 emissions because 75% of Engie's emissions are CO2 emissions are Scope 3, and over 90% of Centrica and Naturgy's emissions are Scope 3 as well. And that really means looking at decarbonising the grids and decarbonising heat. And then we'll look at how these companies are aligning with their net zero legal obligations and how far they are aligned with Paris, the goals of the Paris Agreement, and what the implications might be financially for not aligning. Can we have the next slide, please? So starting off on the left-hand side, the graph just showing what's happened to the gas price or the gas price forwards since June 21. If you take the bottom line, the blue line on the left-hand side there, this is where we were 18 months ago. If you then go up to the gray line, the blue line at the top there, 107 on the left, that's where we were June 22. And now we've come back to where we are in January 23 in the gray line in the middle there. So you can see from the arrows on the left-hand side how gas prices have shot up and now come back down to more reasonable levels. So this volatility is unheard of, and it makes it very difficult, I think, for the gas companies to take a view about the economics of gas when the backdrop is so uncertain. Now, I think this means several things. If we look at what's happened in Europe, it's fairly clear that next winter, we will probably have less Russian gas than we had this winter. And therefore, there is a rush to achieve better security of supply. There are LNG terminals being built in Germany, Estonia, the Netherlands, and Finland at a cost of about 15 billion euros, an enormous build. And I guess the first question is that going to be a build at a price that we can't afford? Are we locking in to long-term contracts at a price that is not acceptable by historical standards? That's the first thing. The second thing is that although Germany in particular has a big need for gas for industry and for heating in particular, there are EU legally binding emissions targets requiring a cut in gas consumption of between 33 and 37% by 2030. And I think the last point about the gas price is that in view of how volatile it's been, and if we also think about how much CO2 prices have increased, gas is becoming increasingly uncompetitive against renewables. And so although the gas price, although the gas argument is, yes, we can give you security of supply, I'm not sure that's as true as it used to be. And it certainly isn't true in terms of affordability, and it's not true in terms of environmental sustainability. On the next slide, so what are the costs of keeping gas open? If we look at those four coal names I mentioned before, so CEZ, PGE, RWE, Uniper, and adding into the mix Centrica, Engie, and Naturgy, they produced 110 million tons of Scope 1 CO2 emissions last year, 2021, and then a further 250 million tons of Scope 3 emissions. These are big numbers. We made a point of starting off with the companies in the CA100 space, which are probably more responsible for CO2 emissions than any other. So this, if you like, is the low-hanging fruit. If we look at how the financial cost of that might look, when we did this work last month, the carbon price at the time was about 83 euros per ton. And if you factor in the Scope 1 and Scope 3 emissions that those companies are responsible for in 2021 and top those figures up at that number, you get to nearly 15 billion euros, 14.6 billion euros. And we would suggest that that number is quite significant if you think about how these companies are valued by the equity markets. Addition to that, some companies now, some corporates are beginning to react to this. It's interesting, I think, that National Grid sold out pretty much all of its gas distribution and transmission businesses last year to Macquarie. Enel as well announced last November in their Capital Markets Day that they were looking to get out of gas altogether. And finally, the European Investment Bank has said, I think in 2019, that investing in gas is inconsistent with net zero. So even funding gas through the bond and debt markets is going to get more challenging going forward. Come to the next slide, please. I said at the beginning that Scope 3 emissions are really the biggest challenge for the gas companies. And we talked already about the weight of Engie and Centrica emissions here. And The problem with Scope 3 emissions is that the definitions are not as watertight as they are for Scope 1. And at the moment, companies are taking the view that quite often these are consumer emissions, not their own emissions, and therefore they're less responsible for them. But I think that over time, this debate will change and there will be growing accountability for Scope 3 emissions. So what do we do about it? I think that whether you look at France or Spain or even in the UK, the first challenge is to try to decarbonize the networks by 2050. This is because in each of those countries, the government is committed to having net zero by that year. So we can't have fossil fuels in the gas transmission network by that time. One solution is biomethane. Biomethane doesn't need any changes to the grid because it has the same molecule as natural gas. However, it's a fairly limited operation at the moment. Engie in France is quite active in this space, but it does need economies of scale to achieve a cost advantage and to cover connection costs. And at the moment, we don't have that yet. The alternative is a longer term alternative is hydrogen. Hydrogen is more complicated because although it can be injected into the gas grid, we can inject up to possibly 10% without requiring any capex. But to get any higher than that, we would need substantial amounts of capex going in. And in any case, it's highly unlikely we can inject hydrogen into the grid beyond 20%, particularly if we think about cast iron pipes, which can't take this. So in both cases, there's a cost issue for biomethane. There's an even bigger cost issue and technical issue for hydrogen. What we really need here, I think, is governments and regulators to start thinking about a regulatory framework which would enable investors to contribute or to invest in this business with some sort of support upfront to make these technologies more commercially viable. Next slide, please. Second big challenge is for Scope 3 emissions is decarbonising heat. If we think about here in the UK, a third of UK emissions are come from heat, and this figure is likely to increase in future. If you look at the housing stock in the UK, 85% of UK consumers and 65% of non-consumer buildings are connected for gas heating. This is a key year, and The Economist had a piece about this last week, actually, about heat pumps in the UK. The UK government is due to issue a heat and building strategy sometime in 2023. We need a clearer target date by which governments are intending to roll this out. And the big point here is that from 2025, it will no longer be possible to install boilers in new build homes. And I think Chris Skidmore, the government consultant last week, was advocating no longer any gas boilers in any buildings in the UK from 2033 as a way of facilitating this. There are lots of challenges here. It's a massive challenge, particularly in the UK, but across the rest of Europe. Possibly one of the biggest ones we would pick out is that at the moment, if we're going to electrify, it's very difficult to see how that could work given the current tax regime. At the moment, because most of the eco costs are charged to electricity rather than gas, the unit cost of electricity is about 4 times the cost of gas in the UK. This is something which the companies don't have any control over, but there has to be something coming from government in order to make that change. Next slide, please. So the question is, how do we get closer to Paris? In the case of Centrica, they need, I think, to accelerate the installation of smart thermostats, EV charging points, and heat pumps in the UK. I think that in the longer term, also, they need to think about how to use the cash flow from businesses in natural decline. So that's the gas upstream and the nuclear assets, because these assets are not going to be around for very much longer. Centrica will need to find alternative sources of cash flow to fund clean growth beyond 2024, 2025. That includes converting gas storage at Rough to hydrogen, which again is going to need some form of regulatory support. In the case of Engie, Engie is not aligned with Paris, quite clearly. This is particularly the case for Scope 1 and Scope 3 emissions from generation. I'm hoping they give some greater granularity about their plans to inject biomethane and hydrogen into the French grid. The French grid is a big deal for Engie. It's 33% of EBITDA. And unless we see some steps in this direction fairly soon, that grid risks being stranded by 2050 when France is committed to net zero. In the meantime, I think they need to take steps to deliver on their targets of raising the renewable build. At the moment, we're only at 2.2 gigawatts in the first half of last year. They need to get to 6 by 2026. This, I think, means ironing out issues in the supply chain. And it's something where it's easy to give targets, but delivering is another issue. And finally, on Naturgy, they too have had delays in their renewables build. This is because they've had particular problems with solar capacity in Europe, I guess related to the China-US issues with solar panels there last year. And finally, I think, unlike the other two, Naturgy's corporate governance could do with some reviewing, particularly when it comes to introducing incentives to management remuneration related to climate issues. That's just next slide, please, just to maybe to tidy up. So just to finish up, so gas used to be the transition fuel to net zero. However, if we think about the energy trilemma, so security of supply, affordability, climate security, at the moment, given where we are, it's not really delivering on any of those three. And that's something we need to think about going forward. The cost is something which, as you've seen, is all over the place and is still very difficult, I think, to quantify in terms of planning assumptions going forward. In terms of how we decarbonize, we need to think about the grids, in particular government and regulators, to introduce a faster work stream to producing sufficient remuneration for these technologies for the grids, particularly in France and Spain, but also here in the UK. How we decarbonize heat, again, government has a big role to play here. It's not just the companies. Centrica has a massive challenge here, but you could make the same case for other countries, other companies in other countries. And finally, Engie is not aligned with Paris. We hope that some of the steps that we've outlined may be getting further down that route. And Centrica and Naturgy have some targets to reducing scope 3 emissions, but these are still going to be quite tough to deliver on by 2030. And that's my presentation. Thank you for listening. We'd be very happy to take any questions.
Yeah, great. Thanks, Chris, for that. Again, if you'd like to put a question to Chris, please put it in the Q&A function, and we can get round to it. And if you have a more involved question, then you please email Chris directly, and he will be very happy to answer that. Now, we've got a couple of things coming through here, Chris. Elaine has very kindly put something in the chat saying, and it's a bit of a technical one, CO2 footprints. How do you go around calculating that, or how does an investor go around calculating that? And then you then slip that further on to an adjusted EBITDA measure. Can you just take us through a little bit more of the methodology to allow people to sort of work out how you're doing that?
Okay, thanks for the question. So at Carbon Tracker, we're trying to align financial metrics with emissions metrics. So we look at the scope 1 and scope 3 emissions that each company produces. We can look at this one of two ways. We can either adjust the cost or the enterprise value of a company for the emissions it's responsible for producing, and we can adjust the enterprise value that way. So to give an example, if we take someone like Engie, Engie produces X million tons of emissions per year. If we multiply that figure by 83 euros, which was the carbon price we took last month, this produces about 6.8 billion euros of implied annual carbon emission cost. We would add that figure to the enterprise value. So the enterprise value metrics over EBITDA, for example, would look higher if we include those figures. And another way of doing it is to think about the EBITDA. So in other words, to what extent can the cash flows from fossil fuels service companies' debt, or are they worth anything in the longer run, given that these technologies are due to be phased out? And this would mean taking a lower EBITDA figure to take out the fossil fuel EBITDA in these companies. So again, you'd have a much higher EBITDA multiple. You can adjust either one side of it or the other side of it. But to drill down this a little bit further, and this is something which I think is an emerging space, Scope 1 emissions are something which companies are directly responsible for, and therefore the cost of producing these Scope 1 emissions is already in the company's financial statements. What is not is Scope 3 emissions. And so what we are thinking of doing is that when it comes to Scope 3, these are produced by customers, not by the companies themselves. And these are potentially, in some cases, costs which may be passed on to the customers at some point in future. So what we propose to do is, rather than add 100% of the cost of Scope 3, we're adding 50% of the cost of Scope 3 to those metrics I just described. So Scope 1, we added 100%, Scope 3, we're adding at 50% to give some idea of what that annual carbon footprint looks like. Does that answer the question?
Yeah, and if anybody's got any, Elaine, if you've got any follow-up from that, then just email Chris Seymour at carbontracker.org. And of course, I guess, Chris, these, you can add 50% depending on your own view as an analyst. I guess you can put whatever input you feel is right. Got an interesting one from Jingying. Thank you very much. And this might be quite involved, but what is a good decarbonisation plan in terms of timeline and measures to phase out gas in power generation and gas sale for these particular companies? Now, maybe rather than just focus on the companies, perhaps we can focus on an overview that Jing can apply to all of the companies that they are analysing. How do we go about sort of setting out the sort of guardrails of what is good and what isn't good? So does that make sense?
Yeah, I'll try and answer that, but it may need more thought. I think the way we approached this initially was to think about Scope 1 emissions and combined cycle gas turbines, and to what extent they produce CO2 emissions. So if you look at these three companies, or even if you look at the coal companies as well, it was actually Engie that was the main producer of Scope 1 emissions. And that's the first thing to think about in terms of how old these assets are and when they should be closed anyway. But I think that what came out of this work, which surprised us to a certain extent, was the level of Scope 3 emissions, and in particular, even with companies decarbonising their generation businesses, how much more important Scope 3 emissions will become in future. So although, for example, 75% of Engie's emissions are Scope 3 today, that figure is going to increase substantially in future. And how we think about that is, something we've are still finding our way with in terms of how we measure it. That 50% figure I gave you before is something which is a first effort to do this, but I'm not sure whether that's the final say on that. In terms of guardrails, I think that 2030 is not very far away when it comes to Paris, and I think that at the moment what we're looking for, and we get companies, by the way, reporting results starting tomorrow, Naturgy tomorrow, Centrica Thursday, and Engie next week, is to what extent are they getting closer to their interim targets? In other words, 2025, how they're doing on that? Because with the Ukraine crisis blowing up in 2022, quite a few of these companies will probably show higher emissions figures than 21 and higher carbon intensity. So we'd like to see how these companies are doing when the numbers are published in the coming days, and to what extent they're prepared to take further mitigating actions so that the interim targets line up with the 2030 figures? I don't know if that gives part of an answer to that question.
Yeah, thanks, Chris. And another one coming in from David. And what I'd like to do is just give this question from David, and then perhaps end with you, Katerina, talking a little bit more about what we can be looking forward to, or what investors can be looking forward to coming forward out of the corporate research team. What are we working on at the moment? So let's just quickly just rattle through David's question. Look, it's very easy. If you look at each report, you've got key questions for management, and there's kind of like a lot there that the government has to do, and it would be very easy for companies and investors to say, hey, we can't do very much here, we've got to rely on the government moving. But to a certain degree, that's not quite the case. How do investors assess what each company can do, rather than believe that, oh, we can't do that because we've got the government to move? Any thoughts on that, very briefly?
Okay, so one thing would be how ambitious the targets are and whether they stack up versus the track record of emissions reductions to date. So how realistic are the targets is obviously one to look at. It's interesting, I think the targets that most companies have set out to 2030 could be more ambitious if you look at what's been achieved to date. And that's one point. The second point is that I think that we've touched on Naturgy and Engie. They could do more to accelerate their renewables build. That I think is really supply chain issues the companies themselves can address. And we've talked also about corporate governance at Naturgy. That's something else again the company could work on. So I think there are things that companies can do, and I think that when it comes to addressing shareholders as of tomorrow, I'm hoping we get a bit more granularity on how that's going to work.
Okay, so thanks, Chris. Look, we've got some questions from Severine on CCUS, the obligatory CCUS question. I think that's going to be a bit more involved. We've got a great question from Raj, and another one from Orlando. Now, Severine, Raj, Orlando, hopefully what we'll do is we'll make contact with you through email and Urbach as well, to answer those questions. But we're getting close to the half hour, and perhaps maybe Katerina, you can just briefly outline some of the more the reports that are coming down the corporate research pipeline.
Yes, we are having a very full pipeline, and we'll be looking to cover within the next 6 months all of the US and global integrated oil and gas majors, the European oil and gas majors. We have already looked at Shell. We will be looking at a few other of the big names on both sides of the Atlantic, actually really the global companies that dominate the oil and gas space. As Chris said, we have already covered, and so now it's very much encourage you to have a look at that if you haven't seen it yet. The European coal utilities, so those are really the big continental names as we know them. We'll be having a look at some of the European integrated names. We are also, so that's next coming down from the side of Chris. And then over in the US, we will be launching coverage of the biggest names over there. So that's the Dukes, that's the NextEras, the AEPs of this world. Again, it's the companies that are really exposed to new renewables build. Some of them, particularly in the US, they'll have some new gas build in there, and we challenge, should you really be doing that? Is that a wise choice in this market environment? And then we will be looking to roll out coverage to a limited extent of Asian utilities. So really what we're trying to do is we'll be continuing the work along the lines of what we've just presented here. What is their current exposure? What do the assets look like? To what extent are these assets exposed to risk of the energy transition, and that risk can manifest in multiple ways. It can come through pricing risk, it can come through volatility, it can come through crowding out of the assets, it can come through government mandates. And I actually believe when we look at the way that things have been going, highly likely there's going to be a much stronger role of government, whether we like that or not, and that can take various forms. And history shows us that very often it may actually increase volatility in the sector and may possibly increase risk, because regulation is addictive. It can only fix certain amounts of things, and then you need new fixes of the fixes. So the bottom line of that is it's the companies who proactively are prepared who will be looking better. So we'll be looking at all these kinds of exposures. How do the companies fare? What are their active plans? How do they take a holistic view on the market environment and the energy transition with it? And we'll be doing that with an oil and gas. And actually, it's we think the oil and gas isn't sheltered from government intervention either, and we've seen that. We know that the sector is very much exposed to this. So it'd be very similar themes. What does your asset base look like, and how can you drive it to a new future-proof and profitable asset base in the light of the energy transition? How can you do this now? And what does it mean for numbers?
Yeah, thanks, Katerina. So we've got a pretty full program. Before we go, a couple of things. One, this Thursday coming up, we've got a really great webinar, and it's entitled EV Drive to Survive. It's rolling out our autos program, which is also headed up by Katerina, looking at each one of the autos companies, which one is going to survive the energy transition and which one isn't, and what to look for. So do, on our website, have a look at that. Also, all of our research is on www.carbontracker.org, so have a navigate around that. And it just remains for me to thank Chris, Katerina, but more importantly, you, the people who have bothered to turn up and have a listen to us. We do massively appreciate that. And again, if we can help any further, or you've got follow-up questions, do get in touch with Chris on cmore@carbontracker.org. That's more with an E. And we hope to see you soon. So thank you very much, and have a good rest of the day. Bye-bye.
Thank you.